Hello everybody and welcome to the Tortoise channel. Happy Monday, and today's video is on building a solid watch list of high quality companies. And this is how you start. Of course, the process, it all starts with the watch list and the companies that you actually put there. And then those are the same companies that you will keep a close watch on going forward. And hopefully you will be able to buy some of them at the right price. At the right price is key here, guys. So I want to be very transparent as always. I'm going to lay out exactly the strategy in the sources I typically get the information from in all of that. Okay, so very transparently, and hopefully this will allow you along your own journey. I share the same process with many of the people that I'm working with, our clients, our partners. And yeah, so let me know in the comments below if you found this video insightful. As always, it takes some time to put these videos together, to gather all the required information. So if you like it, just let me know in the comments, and please smash the like button. But let's just dive right into it, guys. And I created a Word document highlighting the essentials as I normally do. And what's important for us to understand is that a watch list is not a buy list. Okay, so for example, in one of my previous videos, you know that I shared my watch list going into 2026, and not all of that's not really a buy list. It doesn't mean that you should go out and start buying all of those companies. What it means is that they are all high quality businesses, but most of them, the reason you keep them on the watch list is because number one, you may already have a portfolio of enough companies and you don't want to buy more. Number two, those companies on the watch list may be too expensive right now. Okay, and so you're just keeping them there, and then you periodically check in on them and see if the story has changed, if the price has changed, and so forth. Okay, so it's a library of high quality businesses I'm waiting to buy at the right price. Okay, and of course, what if all of them just went down to my buy price level? Would I buy all those 20, 25 companies on the watch list? No, because I run a concentrated portfolio. I don't think you should do that. Even what happens is you have a watch list of options, okay? So 20, 25 companies or 30 companies, that will give you optionality. But then as you go through each of them, you will see that some of them actually aligned more with your values, aligned more with provide better opportunity costs. Okay, so for example, one of them may have come down 50%, 60%, while the other one has come down only 20%. So where does the opportunity cost lie? Those are all things you have to ask yourself. But the point here is that you will be building a great portfolio based on that watch list. Okay, and then but I will walk you through the exact process as we go further down on this list. Okay, so the first thing that I do, and I believe I already mentioned this here, but I want to be very clear on this because this is the first step, very, very important. Start with the meaning, guys. Start with the meaning. Let me just yeah. So this is the winning from formula that I use to build a portfolio of high quality companies that outperforms the market over time. Okay, and the reason that I've been outperforming the market for years is exactly because I stick with this formula. And notice the first M, meaning. Okay, meaning is very important. So start with think about companies whose products or services you already buy. So do you use Google products, Amazon products? Do you go to Amazon and buy stuff from there? So maybe Amazon could be on your watch list. Yeah, if it meets the criteria for quality, we have to talk about about that as well. But the point here is you are gathering a list of ideas, right? A list of ideas. These are companies that have already a meaning to you. Companies because you know the products, you know how good they are. Maybe it's a company you are buying services from, in which case you are already related to the business to some extent. Okay, why are you choosing that particular company instead of a competitor? Maybe they have a price advantage. Okay, maybe we are talking about another mode like switching costs or network effects. I mean, I just don't know. So the work starts with the meaning. Understand what you own. This is another very key, very another important thing. So when I'm looking at companies that I may want to add to my watch lists, I like to understand immediately how they make money. If I can't explain in simple terms how they make money, then I'm not adding them to the watch list. Every single company in a watch list has ticked off this box. Understand exactly how the company make money. And some of them have complex business models. It's very difficult for me to get my head around them. That's a clear no. Okay. So understand the companies, how the companies make money. Yeah. Notice if they have a meaning to also understand if the values of the company align with yours as a potential shareholder. Okay. And then consider the three circles of competence, which we already discussed: passion, money, and talent. This was explained to me by Phil Town. I attended one of his virtual workshops, as many of you watching this channel already know. And he talks about that. Listen, what are you passionate about? Yeah. Do you like, for example, yeah, think about things that you are passionate. Do you like clothing? If you like clothing, I mean, what type of clothing do you like? Do you like apparel? If you like apparel, for example, athletic wear, then Lululemon might be a good option. Okay. Do you use PayPal? Do you like PayPal instead of Wise or any other provider like Stripe? Why is that? So you are trying to build a narrative around certain companies, and the meaning is the perfect way to start this journey. Okay, money and talent, these are things you are very talented at. So it can be, for example, sports. If you like sports, then, for example, it may be that you like a particular gear and you are already buying that from like a company. Okay, in which case that could be part of your watch list. All right, it's another idea. And this money, things you already spend money on. Okay, cool. So that's the first thing. And this is why it's so important. Before screens, newsletters, or numbers, or anything, I start right here. I ask two core questions. Do I understand and feel proud owning this business? So, look, if you don't if you don't think you would be, so if you were given the choice to buy the whole company outright today, would you do so? If the answer is not, then you don't like the business as much. Okay? Just rule it out. Can I clearly explain how the company makes money? I already discussed that. Would I be happy owning 100% of this business today? Does the business excite me? This is very important. Does it excite me intellectually? Because, guys, even though we take a quite laid back approach to long term investing, as you know, you're going to have to check in with those companies periodically. And so if you don't like what they are doing, if you find the business model boring as hell, why on earth would you invest in them? Okay. So does it excite you intellectually? Would you be proud of owning it outright? If I can't explain it simply, it doesn't belong in my watch list. Number two, does it sit within my three circles of competence? So you have passion, I generally find interesting, money with proven economic cash generation, but and talent is industries where I can reasonably judge quality and risks. But this more just refers to what I just discussed, things that you are. Things that you already do, that you are talented in, and then you are more prone to using certain things. Okay, so companies whose products and services are already used are often the best hunting ground for ideas. If a business fails here, I stop immediately. I don't go any further. So when people suggest me new companies, this is the first screener. Guys, if I don't find what they're doing interesting, it's an easy pass. All right. Number two, high quality newsletters and research. I myself I like to subscribe to a few newsletters that I find particularly interesting. And what happens is I read all of them every single day. They send me emails with stock ideas. Okay. And many of these newsletters actually break down investment cases for you completely free. You don't need to pay. It's completely free. And those are ideas that I will then may or may not add to my watch list. It happened many times. Okay, I use newsletters not for stock tips, but for idea generation. Look for managers with long track records, ignore price targets and short-term calls. Ask, why is this business high quality? So I'll give you some example of these newsletters right here. If I show you here my mailbox, look at that. Compounding Quality is one of the newsletters I subscribe to. Compounding Dividends is another one. Zacks is another one. Rule number one, investing is another newsletter, and these are the main. These are definitely the main ones. But you can see is that look at this title, for example. I have yet to read this one: 10 stocks that crushed 2025, or 26 stocks to watch in 2026 part 2. You see, and then if you open them, you will actually see a wealth of information that you can use. That you can use to your advantage, right? So that you can work to your advantage, and so that means more ideas generation, which is important. So, goal: seed ideas, not buy decisions. I want to see, and I need to like the newsletter. What are these guys' track record? What is their approach to investing? Are they traders? If they are traders, I'm not interested. But if they write newsletters but if I know their investment process, and I know these guys ones, so they typically like to buy high quality companies as well at reasonable prices. So that's very good. Okay, it means that they only analyze very high quality businesses that have that durability and consistency in the numbers that I'm looking for. Okay, and then the main problem that I face is the price, but that's something that I can definitely live with for the short to medium term. Okay, so let's continue right here. And stock screeners, quality first. I screen for businesses that already meet my quality filters, not cheap stocks. Typical criteria. So I don't like to filter. So I, contrary to what many people believe, yeah, I don't. The most important thing for me, yeah, is quality. I don't care about the price initially because I know that most of those companies are not affordable by my standards. But the most important thing for me is the quality. If they meet my quality criteria, and those are the businesses that I may want to add to my watch list. I don't worry about the price yet. Okay. Typical criteria. I want to see, you guys already know, high and stable ROIs, returns on invested capital. Okay, how effectively management can turn profits. How effectively management can turn invested capital into profits. Very important. Strong free cash flow generation. Right, that's another thing that I'm after. I want companies that ideally they would be able to convert most of their earnings into free cash flow, which is, I mean, sometimes, for example, a good company, just to give you an example, is Adobe. You can see, for example, in Adobe, the free cash flow is actually higher than net income. So they have a very high cash conversion ratio, which is something that I like. Low to reasonable debt, okay? Consistent revenue growth, proven profitability through cycles. I'm not interested in companies that have been around for 5 years. Okay, I mean, have they survived the recession? It's too early to tell, right? So that's why I keep pounding the table on well-established businesses, because all of that together will remove 90% of noise instantly. Here is a good screener that you can analyze. Again, entirely free. I use stock analysis, and you can use it too. Look at that. Industry, you can select which industries you want to exclude or include. Okay, I typically like to get rid of all industries that are very cyclical, like commodities, industrials, and so on and forth. P ratio, like I said, I put any because I'm not worried about valuation. I'm just screening for quality right here initially. So revenue growth over the past 5 years, operating margins over 50%, debt to equity under 5, the country of those companies. So you can use a screener like inputting quality parameters, You run the search button, voila. Here is a great list of 90 stocks that meet the above quality criteria. Okay, and then you can download this. You can download this to an Excel file and look how this is laid out. So you have company name, industry, sector. Then I have market cap, PE ratio, price to free cash flow PEG. These are valuation things, but this is the quality stuff that I'm after. Profit, excuse me, profit margin, debit, ROI, right? Country, ROIs, gross margin. So this, and you can see the industry and the sector, and it's 90 stocks. So you can walk through this list and you can see how many of those companies might interest you. Okay, which of those companies are you already buying products or services from? Okay, do they have a meaning to you? You can start with this list. Okay, awesome. Now let's move on. Annual reports and shareholder letters. This is something that I also like to do. So as a long-term investor, I actually like to read a newsletter, especially because I see myself as a business owner of the companies I'm invested in, and I read the annual and the quarterly reports. And the reason you can get good ideas is because some of those best ideas come from CEOs explaining their business clearly, and this happens in the annual report, right? Long-term capital allocation records, honest discussion of risks. One of the risks they sometimes discuss is competition, okay? And sometimes, but not always, they even mention what are the biggest competitors to their business, okay? That can give you more ideas. Especially valuable founder-led or owner-operated businesses, companies with transparent incentives. So these are all very good as well, good hunting grounds. And what about what great investors own? Guys, if you don't know this, you have to. If I go to Data Roma is entirely free, and you can see right here what super investors are buying or selling on a quarterly basis. You can look at their portfolios, and you can look at their portfolio. So, for example, if I go here, let's see, for example, Bill Ackman, which is a guy that I like to follow. Look at that. Bill Ackman, Pershing Square. You can see, look, this is his portfolio. So you can see that he currently manages about over 14 billion, right? So he's a hedge fund manager. But look how concentrated his portfolio is. And look at his holdings. Uber, for example, makes up 20% of his portfolio. Brookfield Corporation, 90% of his portfolio. So I'm not interested in these positions, less than 1% of their portfolios. But when I see companies making up 20, 30% of an investor's portfolio, and the investor is someone I admire, then those are the companies you would like to keep a close eye on. Okay, and again, we are looking for ideas. Do you understand how Uber makes money? Is it a company that has a meaning to you? Do you use their services? Right, same thing with Brookfield Corporation. Can you understand how they make money? Would you buy the business today if you could? All right, these are the questions that I'm always asking myself. And then you can check many of the best investors of all time. This is where they have their holdings. For example, Lilu. He also runs a concentrated portfolio, even though this one only shows U.S. investments. But you can see that, for example, Pinduoduo makes up 18% of his portfolio. Alphabet makes up 19% of his portfolio. Bank of America. Again, these are all ideas for you guys. Okay, so I hope that was clear. Just note down this tool, Data Roma, and play around with it. It's very, very cool. And you can see the activity. Look, the recent activity. What have they buy in quarter 2 2025, quarter 1 2025? Okay, what they bought, what they sold. Very, very important. Awesome. So let's continue. Long-term holdings, what they keep, not what they grade, but always ask, would I buy this company at today's price? Okay, so cloning thinking, not portfolios. In fact, I even think I don't think. I remember watching an interview with Manish Pabrai, and he himself says that he likes to do a lot. He's a shameless copycat in his own words. In other words, many of the ideas for his portfolio, he just get them from looking at other investors' portfolios. Okay. Cool. Let's continue. Companies I already understand. Many watchlist additions come from competitors of companies I already know and follow, suppliers or customers in the same ecosystem. For example, if I understand Visa, I have to look at MasterCard, I have to look at Aiden, I have to look at Stripe like models. Okay. If you study ASML, then I'll have to examine the entire semiconductor value chain. Think about the companies already in our portfolio. So, for example, we own Lululemon. Before we buy into Lululemon, we had to understand the competitive environment, right? The competitive landscape. And that led me to study as well Nike, Adidas, Puma, and other companies in order to decide whether Lululemon really had a competitive advantage over all of them or not. Okay, so here we go. By studying competition, that can also generate ideas. In fact, it may very well be the case that as you delve deeper into a company, okay, let's assume PayPal. I was studying PayPal. I saw, for example, Visa, and I may come to the conclusion, you know what? Visa is more expensive, but I think it's a much better long-term investment compared to PayPal. And so I'm going to discard PayPal and I'm going to replace it with Visa. Okay, it could be just one example. Awesome. So, adjacent businesses and ecosystems. Point number 7. Once I understand one great business, I expand outwards. I already discussed that right now, right? So competitors, suppliers, customers, understanding one company deeply often unlocks an entire ecosystem of ideas. This is what we want. Idea generation. Temporary negativity or uncertainty. Some of my best watch list ideas come from short-term earnings disappointments, and you will see these companies all over the news. Okay, so for example, I don't know what broker you have, but if you have eToro, it can be that they give you a newsletter as well daily, and you can see they break down exactly which stocks moved the most over on the previous trading day. Okay, so these are the stocks that will typically make headlines. Yeah, and it can be a negative thing or a positive thing, but those are another more ideas. So, for example, when Nvidia jumped 20% in a single day, everybody started tracking Nvidia. Okay, just an example. I like to pay attention to the big earnings disappointments. Okay, because I'm a value investor. I'm also a quality investor, but so I like to see that a great company becomes cheaper. So when I saw that Lululemon crash 20% after earnings, that really piqued my interest because I know Lululemon is a quality company. And so that led me to analyze the company further. Oh, hold on. So do I have a margin of safety now? Has the story changed? Do I think this is something permanent or temporary? All right. So pay attention to the big earnings disappointments and yeah, that's it. My own portfolio force discipline. If I already own the company, I track competitors always, right? Because I have to check in with them periodically. I study potential disruptors. This keeps me intellectually honest. I know about the space, guys, because I have to. Remember, I think as a business owner, if I think my investment in PayPal, Lululemon, or Alibaba or whatever is in jeopardy, then the thesis is no longer holds, and I will pull out my money. I withdraw my money. Okay. What I avoid is just as important. Unproven, of course. So Some companies that will not never be part of my watch list are, as you know, unproven business models, recent IPOs, okay, no cycle tested, cycle tested data, story stocks with wish cash flows, right? In businesses that rely on hype, not economics. So well established companies are paramount. They are really, really paramount. Not everything deserves to be on my watch list, and that is perfectly okay. I only want companies that are high quality in my watch list, and I need to have proven business models. Okay? So, guys, this is some of the things that I do. And another thing, other sources of information that you guys can check are, for example, Seek Alpha. Yeah, I'm not subscribed to Seek Alpha, but what happens is, let me show you what I love doing, also for free. Who doesn't like free stuff? I'm giving you all for free. Look at that. You can create an account with Seeking Alpha, and what I really like about Seeking Alpha are the authors reports. You can learn a lot by reading or by reading other people who are credible, by reading about other by reading about ideas that credible people post on Seeking Alpha. And so, for example, I have this portfolio right here, which is my portfolio, and you can see that the many authors that are covering these stocks share articles on them. All right, so you can come here and you are entitled to one or three of these articles entirely free on a monthly basis. So information is power, and the more you know, the better decisions you will be able to make. Okay, so here we go. This is exactly what I do, and then of course I watch YouTube because I'm also I also have my we also have our own YouTube channel, but subscribe to other YouTube channels that you find particularly interesting, YouTube channels that align with your approach to investing, and you can find many great ideas. So, for example, if I continue to share, for example, I'll show you what I have. For example, you can see some of my subscriptions right here. For example, Daniel Pronk. You can see that he shares many videos on great companies as well. Look, what I'm buying more. Three stocks to outperform. So many different ideas, guys. And ultimately, you want to have a watch list of, say, 30 companies. There's no point in having a watch list of 50 companies or 60 companies because you will just feel overwhelmed. But if you can build a watch list of 30 companies, 25, 30 companies, then that's awesome. Then, so because they all meet the criteria for quality, that's the most important thing. Then the next step is to start putting a value, is to calculating the intrinsic value of each of those companies. Okay, and why is that important? Because you know those companies are high quality, but what you will find is that most of them are overpriced. Okay, and price is what you pay, value is what you get. So once you understand the intrinsic value, and then you will follow them. All right, and if some of them reaches your buy price, then provided the story has not changed, you may want to start accumulating shares in that business. Okay, so guys, let me know in the comments below if you find this video insightful. As always, thank you so much for being for being with me, and hopefully we're going to have a tremendous 2026. I'm very happy of the community that we are building. Speaking of which, guys, on the let me have a look here. So we have our next live coming up soon. It's going to happen on the 31st of January. Ask me anything, guys. Any stocks that you may want me to analyze live, any questions that you may want to ask. Just don't forget to set a reminder for this. Hopefully, I will be able to meet more of you guys and share this video with people that you may find that you believe could benefit from what we are doing here as well. Okay, thank you guys, and see you soon.